So I want to throw up this chart, taking a look at just kind of the head-scratching situation when it comes to central bank policy versus the, discordance that we see in the markets. It seems the best interest rate policy really is to not have one at all. And we have a lot of these central banks globally just treading water. It's data dependent. We're going to see whether the inflationary expectations are just a blip and whether it's really just reflation, right? What was your takeaway from what Fed Chair Powell said overnight?
Look, with what we saw overnight, I guess, it was a little bit lesser than what the market was expecting. Hence, we saw a bit of a full pullback in yields. But having said that, what we would be seeing going forward with the Fed particularly is beyond this meeting. We've got upgraded forecasts on inflation and growth. We expect to see these play out into the next month. Next month's meeting is going to be key because then they're going to really talk about the look through the higher inflation numbers, and at the same time, look at the GDP growth on the back of fiscal stimulus checks that have just been paid out. Now, for us, the June meeting is key. We have similar projections as the Fed into a stronger economic data coming out of the US, just on the back of strong recovery. And so what we're expecting to see is a change of tone, potentially in the June meeting. And probably then they might sort of signal, first of all, they might have a rewrite of the entire statement, followed by revising their inflation and growth forecast on the upside. That's when we will see potentially a signal for future tapering and moving on September, October, announcement of a tapering due in December potentially.
So in terms of where that leaves the bond markets, right? At what point do we see investors having to believe in the Fed, having to believe in the RBA, for example, when they say, rates are staying exactly where they are until we hit this inflation mandate for the Fed? The dot's still showing 2023, but, Fed fund futures still pricing in tightening from potentially before the end of this year.
Yeah, that is true. I think it's a bit of a tug and war divergence between central banks and markets. With the RBA particularly, I think, again, in the last week or two, we have heard repeated commentary from Governor Lowe saying the same thing, consistent messaging. Rates are not, going up for an extended period of time. And one thing I must say is that they've also, in fact, instead of any hints of tightening, we're actually expecting more easy policy ahead for the RBA. We are expecting, the November, the rollover of their bond purchases for April 2024 to be rolled over to November, which effectively means lower for longer. So it's really, I guess, going forward, as you said, the US Fed policy probably will take a head start in terms of raising rates when they do, potentially as we see in 2023, while the rest will be, will play follow up as and when their economies come to par with matching pre-COVID levels in terms of GDP and other measures.
What does it mean for equity markets then? Because you have higher growth forecasts, you have at least central banks telling you, wait, we won't be doing anything when it comes to tapering. Is it just up from here then?
Yeah, it looks like up and away from here, to be honest. And it's just that what we have seen, I guess, more of a tug and war between the rotation over the past weeks, and in line with the fact that yields are going to move higher, and yields moving higher because it's good news, good data. And so we are seeing that move from, stay-at-home stocks to reopening stocks. And that's a fair movement to see. And similarly, what we are also doing is getting on the bandwagon, moving into our value plays, because we are very clear that the PEs for growth stocks particularly are exceptionally high, and if we do see yields moving higher, which we are expecting, then the future cash flows of those growth stocks will get impacted on the downside.
And what do you like in the bond space, given that, as we established, we are seeing this rate sell-off because of great news that growth is recovering?
I think with the bond space, we are very tactical. I must say that towards the end of last year, we became underweight investment grade US dollar bonds. Currently, in the US dollar space, we like Asian high yields, particularly, I guess, China credits, starting from China government bonds up to their corporate space. There's a huge pickup in spreads, well over 200 basis points there of value that we see. In the Aussie dollar space, again, we are very selective, and I think what we're focusing on is really the shorter duration bonds. And within that space, it's really the perpetuals or the hybrids here, which come with that shorter duration and very attractive yields as well.